Wall Street made a strong start to earnings season after a windfall from deal-making. The biggest US banks kicked off earnings season with a bang this week. 4 out of 5 big banks reported an increase in quarterly fees from advisory work, and they're forecasting that the Trump administration's push for deregulation will mean an even stronger year ahead for M&A. That's a strong tailwind for earnings season, which gets busy next week with Netflix and major US airlines on deck. MacDonald is an investment manager at Aubrey Capital Management. A very strong quarter for the big banks then. What's driving all this deal-making activity?
Well, as you've already mentioned, and as was highlighted particularly by David Solomon, the chief exec of Goldman's, he's saying that, both CEOs and boards are looking and saying, OK, with the Trump administration, we've got a window here of a handful of years with the opportunity to continue really what he calls big strategic transformative things. So companies are thinking the Trump administration is more relaxed about big deals and market concentration than the Biden administration was. We've got another 2-3 years to try and get some big deals through. So that is allowing those banks to go to their clients and say, come on, this is the time to be doing these big deals.
We also saw a big uptick in equities trading revenue, didn't we? Driven by these high stock prices that we're seeing.
Driven by high stock prices, and always you've got to think about volumes as well. I mean, Liberation Day might have looked pretty awful for, from the outside, but huge volumes of trading are very good for those for the equity trading desks. And we saw that Goldman Sachs had a record quarter in the fourth quarter. That was $3.1 billion from equity trading revenue. And I think that I looked here and it says $60 billion in revenues made by the big banks for equity trading during 2025. As you know, there's been a lot of trading. There's been as you say, stock price rises. And there's also been quite a lot of movement. We've had a lot of investors looking to sell some US equities and move into equities in Europe and the UK, for example.
Do you think this sets a positive tone for the rest of the US earnings season then?
Well, I think we've got some mixed results. I mean, we do see further mixed signals. We do see further deal making that might happen. Obviously, trading is going to continue. Some of the big banks have insulated what can be quite volatile trading and deal making by growing their asset management business. We saw Morgan Stanley have now reached $9 trillion under management. So that helps them smooth their earnings. There are some clouds on the horizon. We've heard what Trump had to say last week and this week about credit cards interest rates being capped at 10%. Now, the banks are lobbying hard back against that, and it's sort of unclear about whether he can do that kind of thing by executive order. So, we've got some clouds on the horizon. Could it be those capping of interest rates, however they might happen, as Trump sees this a way to try and encourage improve affordability for his voters? And is there anything else he might do in the run up to the midterms to try and fully capture his voters' minds about, maybe it's a bit of language against the big banks?
The next couple of weeks are busy ones for European earnings, but the forecast is not quite so good. LSEG data shows analysts are expecting the worst earnings performance in Europe for the last 7 quarters. Why do you think that is?
Well, I mean, there have been some pretty strong earnings progressions over the last year. So comparatives are a bit harder. We've seen some really good outcomes from European banks. We've seen some really good results from the metals and mining stocks. And so it's just thinking about how much further they have to go. The banks, if we're seeing some interest rate falls still to come, will that affect their earnings potential? So I think it's a lot to do with the makeup of our sectors and where we might see those growth areas. As we know, by comparison, the S&P is very tech heavy, and we've seen some very good earnings progression there.
European luxury will be in focus over the next couple of weeks, Anna. That sector faltered a bit in 2025. What should we be expecting?
Well, I think the tone has been set a little bit by Richemont, and this is a $115 billion luxury good company, which is back near all-time highs, unlike some of its comparators like LVMH and Kering, which are still down from those levels. They talked about sales being ahead of estimates, up 11% over the year. And this is despite having quite tough comps. What's really been working for them is the jewellery sector. For example, I think they highlighted that Taylor Swift and Timothée Chalamet are wearing Cartier jewellery and encouraging others to buy. What we've seen is double-digit growth in the US, the Middle East and Japan, and actually buoying investor sentiment quite a lot is 6% growth in mainland China, which is really encouraging after what's been some pretty tough trading there as Chinese consumers have rebelled against the high levels of price rises, and that's really reassuring that we've seen that change. We're seeing Burberry next week. They've got a trading statement, and then towards the end of the month, LVMH, which is the real giant of the sector, will be reporting and carrying into next month.
That was MacDonald of Aubrey Capital Management. Don't forget, you can watch more videos on Reuters.